A complete, honest guide for long-term investors. A quietly decides your financial future. Let me ask you a question that sounds simple, but quietly decides the direction of your entire financial life. Should you invest your money in equity funds, or should you invest in debt funds? Most people answer this emotionally. Some say equity is too risky. I want safety. Others say, debt is too slow. I want higher returns. But here's the truth. Most people never hear clearly. This is not a competition. One is not better than the other. The real answer depends on you, your age, your income stability, your time horizon, your emotional tolerance, your financial goals. In this video, you will finally understand what equity funds truly do. What debt funds are actually designed for, why people misuse both, and how intelligent investors combine them. Welcome to Wealth Principles Lab, where we don't sell motivation, we explain how money really works. Why this question confuses almost everyone. Most beginners ask the wrong question. They ask, which fund gives more return? It's like asking, which is better, a car or an airplane? Better for what purpose? Equity and debt funds are not competitors. They are tools designed for different jobs. When people ignore this, they invest emotionally, panic during volatility, blame markets instead of strategy. Let's remove the confusion completely. What equity funds really are without hype? When you invest in an equity mutual fund, you are buying ownership, not speculation, not gambling. Ownership, your money goes into real businesses. Companies that sell products, provide services, generate profits, grow with the economy. If businesses grow, equity funds grow. If businesses struggle, equity funds fluctuate. Equity funds build wealth mainly through long-term appreciation in company value. Dividends reinvested over time. This is why equity is powerful and emotionally difficult at the same time. Understanding equity volatility the right way. Equity funds move up, down, sometimes sharply. This movement scares people. Volatility is not risk by itself. The real risk is selling at the wrong time, stopping investments during fear, expecting stability from a growth asset. Equity does not destroy wealth. Poor behavior destroys wealth. Those who stay invested through cycles are rewarded. Those who react emotionally are punished. Who equity funds are truly meant for. Equity funds are suitable for people who have long-term goals. 10 to 20 plus years can tolerate short-term fluctuations. Understand that markets move in cycles. Want to beat inflation meaningfully. Equity funds are not ideal for emergency money, short-term needs, people who panic easily. Equity is not dangerous. Misusing equity is dangerous. What debt funds really are? Debt funds work very differently from equity-based investments, and understanding this difference is crucial. When you invest in a debt fund, you are not buying ownership in businesses. Instead, you are lending your money. That money is lent to governments, corporations, and financial institutions that need capital for their operations. In return for lending this money, you receive interest-based returns. Because the income comes from interest payments, debt funds are designed to be more predictable. Their primary focus is not aggressive growth, but capital protection, income stability, and lower volatility. This makes debt funds behave calmly compared to equity funds. They are built to reduce sudden shocks and provide smoother performance over time. Debt funds don't aim to excite investors. They aim to reassure them. Why debt funds feel safe, and the trade-off. Debt funds feel safe for a reason. Their prices usually don't swing wildly. Returns tend to be more stable, and short-term losses are relatively rare compared to equity funds. For many investors, especially beginners or conservative savers, this calm behavior feels comforting. However, this safety comes with a clear trade-off. Lower risk almost always means lower long-term growth. Debt funds are excellent at preserving money, but they are not designed to multiply it aggressively. Over long periods, their returns may struggle to significantly beat inflation. This is not a flaw in debt funds, it is their purpose. They are meant to protect wealth, not rapidly expand it. Who debt funds are best suited for? Debt funds are ideal for investors who have short to medium-term goals, such as saving for a planned expense, building an emergency fund, or protecting capital they will need soon. They suit conservative investors who value stability. Overgrowth, as well as people approaching major life expenses or retirement. However, debt funds are not meant for aggressive wealth creation or for beating inflation on their own over long periods. They provide peace of mind, predictability, and balance, not excitement. Growth versus stability, the core difference at its core. The choice between equity and debt is not about which is better. It is about time and temperament. Equity funds offer higher growth potential, but come with higher short-term volatility. Debt funds offer stability and lower volatility, but lower long-term returns. Time gives equity its power, while temperament determines whether you can stay invested without panic. Why salary earners must balance equity and debt. Salary earners face a unique financial challenge that many people underestimate. Income usually comes from a single source, arrives on a fixed schedule, and grows slowly over time. Expenses, on the other hand, are predictable but constantly rising. Inflation never pauses. This creates pressure that requires careful planning, and salary earners place too much money in. Debt-heavy investments, purchasing power slowly erodes, and long-term growth suffers. But when they place too much money in equity without preparation, emotional stress often leads to panic and poor decisions during market downturns. For salary earners, balance is not a luxury, it is a necessity for survival. The role of time in investment decisions. Time is the most powerful and misunderstood factor in investing. With a long investment horizon, equity becomes less risky. Market volatility smooths out, temporary declines lose their power, and compounding accelerates growth. Over short time periods, however, equity becomes unpredictable and stressful. Debt funds provide stability and protection. This is why younger investors should generally tilt more toward equity, while older investors should gradually increase debt exposure. This approach is not about age itself, but about how much time your money has to recover from fluctuations and grow. Inflation, the silent decider inflation, quietly reduces the value of money every year whether people notice it or not. Debt funds may struggle to beat inflation over long periods, but they offer stability and income. Equity funds are designed to fight inflation by participating in economic growth. Ignoring inflation is one of the costliest mistakes investors make. Saving protects money. Debt stabilizes money. Equity grows money. Equity grows a distinct role, and ignoring any one of them creates imbalance. How smart investors combine equity and debt. Smart investors don't choose between equity and debt, they combine them strategically. Equity is used to build long-term wealth, while debt is used to stabilize the portfolio and reduce volatility. When equity markets fall, debt provides balance and emotional comfort. When equity markets rise, growth accelerates. This combination reduces stress, improves consistency, and leads to better long-term outcomes. A simple age-based framework in your 20s, higher equity exposure, and lower debt exposure generally makes sense. In your 30s, equity remains dominant, but debt begins to play a supporting role. In your 40s, balance becomes more important. In your 50s and beyond, debt allocation increases to protect accumulated wealth. These are not rigid rules, but guiding principles. Why most people fail, and the final truth: people don't fail because equity or debt funds are bad. They fail because behavior breaks the system. Panic, return chasing, frequent strategy changes, and unrealistic expectations destroy results. Equity punishes impatience. Debt punishes unrealistic growth expectations. Wealth is built through understanding asset roles, staying disciplined, and giving time the space to work. Equity and debt are not enemies, they are partners. When used intentionally, they create both growth and stability. This is the Clarity Wealth Principles Lab exists to provide, because wealth is not built fast, it is built correctly. If you want calm, intelligent financial education, long-term wealth thinking, and strategies that actually work in the real world, make sure to subscribe to Wealth Principles Lab. Because money doesn't reward emotion or speed, it rewards understanding, discipline, and time.